Welcome to Lighthouse Outlook, the podcast where we talk less about the markets and more about what matters to the people navigating them. From family offices to founders, we go beyond the numbers to unpack risk, legacy, and the human side of capital. Hosted by the team at McNichol & Associates Asset Management.
Welcome to the MEM Research Meeting for January the 29th. We do have year-end numbers for the Alternative Asset Trust. We'll get into those in just a second. Before we do that, just drawing your attention to the disclaimer on the screen in front of you. So the Alternative Asset Trust, this is our top fund in the alternative space, well into its 15th year. And last time we talked about some of the LPs, the underlying middle layer. Today we'll look at the overall top fund. It was a pretty good year for the trust, 7.4% net of fees. And we do model out things like carry for some of the older vintage funds that are into the later stages of their investment cycles, as well as some of the tax considerations like FATCA. So it's a very clean number. And, I think it was a story of that last quarter, being a little bit more consistent for the trust. We saw good results from things like music royalties, private equity secondaries. Our land banking positions are doing very, very nicely indeed. And then we did have some more mixed results in the hedge fund, but the balance of evidence was on the side of the positive, which is great. So that's good. Just taking a look at the charts of the week from Andrew over at SOT Strategy. Again, we've talked about this before. He does a good job of kind of focusing on technical analysis, but also, not necessarily putting the blinders on. So in this case, he's kind of pointing out this fairly obvious absence of blockbuster earnings results so far. And, that's always a problem when you're, at elevations that are quite high on the valuation front. I think the Warren Buffett indicator is something at 120%, which is quite high. And then I think early in the action yesterday, we got to 7,000. So, hooray, we did it. A lot of people saying, okay, now we can have the crash, but it doesn't really look like that overall. I think Andrew is pointing out things like the fact that the market is really resilient. That's sort of something that, you saw throughout his write-up and the individual charts. And so you could see here, the S&P 500, it has taken a few, trips down to that 50-day moving average line, but it's really done not a bad job of kind of staying in between that first and second standard deviation band for, maybe a year now. Again, there's been periods like last April when, it dipped down below that, but overall fairly resilient. And so here you can see the upward trending channel in the S&P 500. And I think that he's kind of on the S&P 500 overall, he's kind of more at the center of the table as to whether this goes higher or lower. He's, like a lot of people, I think it's really a lot easier to make a long-term bullish call, back in kind of in October of 2022 or those sorts of environments versus now, saying the S&P goes from 7,000 to 10,000 is, one of those calls that can make your career look a little bit silly. So you're not seeing as many of them. With that said, tech is breaking out here. This is the NASDAQ, the QQQs punching up through that upper line in a fairly decisive way. So that certainly doesn't look like, an accident or some algo that was, in need of a tune-up. So that's good. The MSCI All Country World Index is breaking out as well. And this is something you're starting to see more, not only in technical newsletters, but in general. And so it's sort of the opposite story to the longer term recent dominance by U.S. equities. And so, I think that's healthy to sort of look around the world and see what else is out there. So you could see that there from this slide. This is that he did a lot of work on sort of the resilience here. So there's a lot of bars and numbers and write-ups here. But to summarize, he's kind of looking at the stock market, in recent quarters and saying, look, any dips that we've had have been pretty good opportunities to maybe not quote back up the truck, so to speak, but they've been good buying opportunities because the market has been so strong. So to that point where, you're up in that sort of maybe not the third standard deviation, like clearly overheating relative to, someone like a 50-day moving average, but you're certainly in a market environment where, dipping your toe in on these dips is, maybe not the worst thing in the world. And so here again, this is just a different look from the S&P 500 performance after the initial move above various threshold points. And depending on whether you're a growth or a value investor, sometimes you look at high multiples or high pricing levels on an index, and you say to yourself, kind of, gee whiz, that's overpriced. That's not actually worked out too badly for people that are chasing growth and momentum. You probably shouldn't do it all the time, but from this analysis, you can see these various thresholds have actually worked out okay. So that's positive. Just taking a look at a few other things here. With crude oil, think he sounds more positive. It looks like a downward sloping chart, but he sort of calls this a floor level for WTI. It's kind of hard to see from the screen, but on the right hand side, it did kind of breach into that green bar of support, which looks like green jello. If anybody eats jello on the call, it's pretty much the same color, and it is kind of bouncy. So it looks like the index in this case, the commodity WTI hit down into there and bounced back up. And then he's talking about something that you occasionally hear, but not that often. It's sort of the performance of gold relative to oil. Obviously in the last maybe 18 months, it's been a total mismatch. Like, it hasn't even been close. And, more and more of the newsletters, and granted, miners are a very sort of rocky bunch, but you do get these very, like these prospectors are just sort of a different breed. Anyways, I won't get into that. The main sort of thing here is that, whereas with gold, he sort of calls it being in quote uncharted territory, you kind of have a better sense that, potentially there's a floor in here for oil. So we shall see. And then one more thing here. We talked about this kind of on the more infrastructure side, but when we did our year-end commentary for the trust, we pointed out that a lot of global equity markets really were firing on all cylinders last year. India is not really one of those markets. I don't know exactly. Obviously, I'm not an expert on Indian equities, but they have really broken down through this lower line. I believe it's the lower end of the Bali band. That's been a traditionally decent place to pick up Indian equities. So if you're looking to add some, Asian South Pacific equity exposure to your portfolio, this is a big country with lots of companies and, tons of smart people. So potentially an opportunity. And that's it for myself. I'll pass it back to the group.
Okay, cool. Just looking here first at the S&P 500, four-box reversal this week to an all-time high on this chart. You can see the third straight buy signal there. Obviously, some tariff worries decreased with some less harsh rhetoric from Trump, we'll say. I was talking to Gilbert earlier this morning. The Fed nominee looks like it could be someone other than Hassett or Warsh, and someone who's a little more independent. A guy from BlackRock, Rick Reeder. So we'll have to see if that obviously comes to fruition. But nonetheless, still some other areas that are impacting the market. Obviously, we're in the heart of earnings season. Yesterday, Microsoft, Meta, Tesla, IBM all reported some strong numbers. And then you have Microsoft, which saw a pretty large drop in their stock price after their earnings were released on slowing cloud growth, and their guidance, I think, on the margin side was a little weaker than expected. Nonetheless, S&P 500 heaviest it's been overbought since October 3rd. Momentum looks positive, so a bit of a reversal on the technical side. On the fundamentals, still pretty expensive, like we've said, at about 28 times earnings. Then looking here in NASDAQ, 5-box reversal as well. Second straight buy signal. It's at its all-time high resistance from October. Funny enough, I was looking at the NASDAQ sectors, and the leading sectors obviously this year, no surprise, commodities. But you can see obviously PE ratio. These are from FactSet, very elevated. Overbought, oversold, also the highest since October 31st. So a bit of a reversal here in this week. Seems some inflows and some improving fundamentals, or not fundamentals, technicals, excuse me. And then looking here at the Dow, 2-box increase week over week, a couple column changes. It did not create a buy signal. And now it has this really strong resistance. 4 times in a row, it's reached this level at 49,600, and it's reversed down. So that's something to watch moving forward. Overbought, oversold, decreased every of the last 4 weeks. It's funny. Like I mentioned last week, value looked a little more attractive from a technical standpoint to start the year. This week, we saw a bit of a pivot there. Where the S&P and NASDAQ are displaying some stronger technical attributes. Then looking here at the TSX 60, no box change week over week, obviously continues to be led by commodities. Some of the miners have had extremely hot starts to start 26. Obviously, gold and silver prices surging. You can see here the support lines, P/E ratio obviously lagging their US counterparts, but technical and fundamentally, it looks the most stable and strong compared to other US indices. Overbought, oversold was the lowest in 4 weeks, but remains heavily overbought over the last 9 at about 60% this week. So really bodes well for our Canadian holdings. Looking here at the VIX, 3 column changes. Vol continues to rise with obviously numerous risk factors, including Trump's kind of unpredictableness, we'll say, but that's not new news. But really off that low that we saw in December, really making this first uptrend since we saw in September to October. When we got a bit of a peak in the VIX. So we'll have to see if that continues. Bullish percentage chart, no changes here, static this week. So we'll flip through these pretty quickly. Like I mentioned, percent positive trend is a delayed moving chart. It's a lagging chart and indicator. So it's no surprise this has decreased with some of the weakness to start the year and some of the names in the NASDAQ. Dow remains in the same spot. And then the Canadian indices remain in positive columns, but haven't increased any more than they were just a couple of weeks ago. Looking at the asset class rankings, a lot of flow into international equities, especially Latin America. It's been on a rip over the past couple of months. And then down here, currencies, US dollar weakness, obviously leading to a complete reversal over the last year where the US dollar was in the first position here, completely flipped, and emerging currencies for the first time in a couple of years is actually ranked first within the currencies. And then the biggest mover within the sectors, energy, 13 buy signals week over week, just when you thought energy was a left for dead sector with oil prices kind of dropping into the 50s. We've seen a complete reversal with natural gas prices moving upward, uranium prices moving upward, obviously, and then even oil. I think I have a chart that explains a bit of a bottom there. Now, first sector spotlight, obviously, just want to talk about gold, $5,000 this week, first time ever. Price target on the Dorsey Wright system is about 6,800, so implying even more upside. That's the highest I've seen. This is also on the $50 chart, so it's scaled out. It's up 18% year to date, massively overbought on the technical side. We obviously all know the fundamental story with gold. This is just tracking the price of gold over the last century. It's a little from the World Gold Council, but you can see the nominal gold price versus adjusted for inflation, obviously hedging uncertainty, inflation, and a collapsing US dollar, which I've mentioned. Looking here, this is gold oil, like I mentioned a couple seconds ago. It's up 8% year to date. Why? Supply expectations continue to tighten. There's a bit of a geopolitical risk premium, obviously, with what happened in Venezuela was an event for oil. A lot of people thought it was bearish because the U.S. would just utilize Venezuela's oil and they'd be able to get it out of the ground. But the amount of capital that is required to do that will take quite some time, and increasing production can't happen overnight, especially in a place like Venezuela. You obviously have the Iranian risk premium, but I also think a lot of the mass producing countries, Saudi Arabia, oil trading in these isn't really advantageous for them, especially some of those Arab countries. They need oil prices higher to finance their budgets and their advantageous spending commitments that they have. So having the price sit in the mid 50s, I thought was kind of a bottom just on a pure supply and demand side. But you can see we're approaching this trend line, which we've been under for about 5, 6, 7 months. And if it breaks above that, it could have some real velocity on the technical side on that chart. Now, I kind of misordered these charts. This was supposed to be after the gold chart, but nonetheless, US dollar index at the lowest point since 2021. Trump did say that he was going to devalue the dollar, and we've dropped from about 109 on this index to 96 within a year and a few days. He's devaluing the dollar. He wants U.S. exports to look more attractive to other countries, but it obviously it comes with some downside. Purchasing power of the U.S. consumer dollar down 53% over the last 30 years. Another reason, obviously, to own assets, including a number of commodities, which we own. Looking here, this is a number of Dorsey Wright charts that I talked about earnings this week earlier in the presentation. Meta, Tesla, Microsoft all reported yesterday. Microsoft shares opened this morning down 11% on some light markets, some weaker cloud revenue growth. Tesla shares and Meta shares opened higher, and then Apple, Microsoft, you can see this support line at 440 has opened up below that, and you can see the nearest support line after that is a few boxes lower. Moving on here, this is a chart that I found in a newsletter this week. It's just a chart that tracks unrealized gains or losses on investment securities by U.S. institutions. A couple years ago, obviously, this surged with rising interest rates. It still remains a heavy problem with around $375 billion in available for sale or held to maturity securities that are sitting on unrealized losses. Now, why is that an issue? Obviously, if any institution has some liquidity needs, those would have to be sold at a loss. G front, a little all over the place today, but I just wanted to highlight this for the Canadian energy bulls. The Europe and the European Union as a whole want to decrease their reliance on the U.S. The U.S. dominate. This is Europe's LNG imports. In the blue line is the U.S., or excuse me, the black line is the U.S. and the blue line is all others. Over half are U.S. supply. And they are looking for a reasonable trade partner, potentially Canada, if we can get the infrastructure in place. Could be really bullish for a number of natural gas stocks in Canada. So we own this exact ETF XST in our relative strength platform, trend since 2004. You can see the tiny little blip that it had in 22, still really strong returns. Obviously, we all know staples, sometimes against recessions, but we think it's a bit of a complement to growth and cyclical stocks and cyclical ETFs. It's up 18% over the last year. Its largest holdings are a number of securities that we own directly in some of our other accounts. And it's not extremely overbought. The technical chart looks strong. You can see the steady increase, and we expect that to continue moving forward. Markets are very toppy. Potentially a nice complement to add into your portfolio if you're looking for some more staple options or defensive options. And that's it for me.
Okay, thanks. Michael Kuba has a new PDF viewer that I'll try to get my way through here. Fortunately, the bar doesn't, you can't really see the years. I don't know if I can move it or anything, but here he's talking about pick your release valve. Above 150 of the USD, Japanese yen, being a pain point, it must say, for the Bank of Japan. And notice how each time there's an intervention, sudden drop in the currency, the yen yields tend to follow on a lag with a move higher. Pick your poison. Yeah, I'll have to speak to him about this because that's no good. I can't see those calendar years at the bottom. Fed cuts to lower rates. The 30-year yield is nearly unchanged since the Fed embarked on its latest easing cycle. This shouldn't be a surprise, but just goes to show the limitations of pouring gasoline on a fire. Yeah, and I've been watching that just about every day. I update a chart for the long bond, and yeah, it actually continues to move up, which is also a very strong sign of inflation. Not overly complicated. Rising commodity prices cycle into inflation. A weaker U.S. dollar only exacerbates this dynamic. Our exports are cheaper to other countries, but imports become more expensive in U.S. dollar terms. Commodities tend to lead yields. Interesting. Not a conspiracy theory. BLS CPI imputation percentage. It's not a theory that data is being made up. The BLS is telling us themselves through their own data. And the Bureau of Lies and Statistics, it used to be cynically called and probably still is. Russell's recent dominance. To demonstrate how unique the recent run of R2K's outperformance has been, it's the second longest streak on record. Gold-infused growth boom. For as much flack as PMIs have received since COVID, they're still relatively useful. I'm not sure all the projections of 5% GDP growth. Atlanta Fed is at 5.4. Will ring true. We have to remember that imports over exports impact GDP, much like Q1 24. Major gold imports reduce GDP. The reverse will be true, and the recent surge of gold exports will boost GDP. Multifamily permits look to be bottoming. This doesn't necessarily bode well for homeownership, as renting is still significantly cheaper than buying in the U.S. It's worth pointing out that Trump's proposal to ban institutional investors from the housing market does not apply to multifamily. Well, that's good because we're big time into that. I think it just What he's trying to do is get the Blackmonts of the world to stop buying single-family homes and chasing up prices in neighborhoods and making it continually unaffordable for the new person trying to get into the housing community. A rebound in multifamily construction is potential tailwind for our housing affordability theme. Family permits and construction. As we can see, the stabilization is far clearer in multifamily. Not sure the backdrop improves much for single family, given Trump doesn't want to negatively impact housing prices, per his own Davos speech. CRH is an Ireland-based building materials company. North America represents 75% of EBITDA, but this is yet another name that could gain a tailwind from the rebuild Ukraine. Okay, that's an interesting one to look at. Budimex is another construction company located in Poland. Per a Budimex press release, representatives of the Ukrainian administration emphasized that Budimex is a well-known company in Ukraine. So another Build Ukraine story, and that is it. So thanks for that. Now let's just take a quick look at just the performance year to date. France and India, the only two that are negative. Venture capital in Canada continues to dominate, and Japan is having some strong results here, to probably showing an offset to their inflation rates. Similar numbers probably. So lots of movement with venture capital in the last month, and so we're off to a decent start. Commodities, as it was pointed out by that analyst at Dorsey Wright, gold has taken a turn for the better, as is nat gas, and gold and silver continue to dominate. Look at these numbers, crazy. Thinking more about it, and I'd love to hear other people's comments later on. It's really a sign of just the problem in everything with interest rates weakening, purposely weakening of the US dollar. And really, the banking system is going to, in my opinion, be affected by this at some point in time, where people just are not believing in fiat currencies, and there's a show of money being run at certain banks, and even just getting more difficult to access physical cash. That could be turning into more digital cash. And there's going to be some U.S. commercial banks that sooner or later will have to disclose that they've been on the short side of this, trying to keep these prices down, but they are literally like a super ball that bounced straight back, with gold hitting 5,600 yesterday, and 5,300 on this one as well. Copper continues to show strength. I'll, as always, show the Canada US dollar and interest rates on the point and figure, and I'll go to that right now and finish up shortly. So we have seen the Canadian dollar strengthen a little bit here, and this is a new change here. So the short-term indicator shows it going from 74, where we're at 72 last week, up to 77. So we're gonna have to watch this and be careful that we don't give back our U.S. Currency wins to this. The long term still holds it back at 62. So we shall see. Maybe the Carney's strong speech at Davos has had some effect. And the Canadian dollar is very illiquid. When foreigners come and buy it up, it can move quite rapidly. We've seen the weakness in the US dollar spot index, but it still does show upside from here. So time will tell what's happening there. And moving on finally now to, we've already talked about crude oil. So it's got a higher target now. So that's rolled over from 63 up to 72. Nat gas has come off a little bit here, but still shows, almost another triple to its target. So maybe that tells of another cold spell coming through that North Americans still trying to cope with right now. Energy stocks look to be higher. Copper looks like it's topped out here. Uranium strong. Gold has gotten ahead of itself here into the 5,300 range. We'll probably take a pause and go sideways for a bit. Gold bugs point down, as do the VanEck seniors, and the juniors up a bit. Silver at 113 right now measures down. So it might be time to take some profits out of silver. And as even the juniors have come off quite a bit here. And finishing up, Bitcoin still has a very high target. Ethereum looks to be coming off, as does Solana, as does the whole crypto index. Is it dead? Probably not, but people are taking a pause and taking some money out of it. The Canadian banks look strong, 58 up to 104, so they're unaffected, and maybe some of them actually have some deep involvement with precious metals. They can be beneficiaries of that. The U.S. brokers look strong. I missed the U.S. banks up there. I jumped through them. So yeah, the majors look to be topping out in the U.S., but the regionals look to be very strong with the consolidation going on there, and we've got a starting point with a regional bank fund consolidator. And finally, with interest rates, the 2-year has not really moved down much and should be following what the Fed's trying to do, and sooner or later it probably will inch down to 2 3/4. But the 5 years up, the 10 years up, and the 30-year measures down. So even though it still tends to track up in the short run, who knows? These vertical price objectives are nothing you can hang your hat on. I look at them as just a bit of a trend following, but not 100% foolproof. Paul, flip through your charts. Looks like it's going to be an interesting presentation.
Yeah, I mean, it's a very straightforward presentation. It's like I got 20 minutes to talk in front of 1,000 people, and everybody can't see, they're big screens. They can't really read much. So it's just a quick flip through. We just talk, and basically say, look, value investing is the way to go. For good reason, because when a stock goes up 3 or 4 fold, it may still be cheap. So that's I come into that Eris Mining. I still maintain it's the cheapest gold stock in the world, and the stock's gone up 300% or 400% or some number. But if you do the math, trading at 3 times, maybe 3.3 times EBITDA, and so and they have no debt. In fact, they have excess cash, and they have growth. They're going to grow 30% a year for the next 5 years. Oh, the stock's still cheap, and that's why it's our largest holding, and that's we're recommending you stick with it, right? So Eris Mining, that's one, and then we talked about others, silver, right? It's pretty obvious. We talk about MDA. I think MDA Space, I think that's the cheapest technology stock in Canada. The thing trades at 9 times EBITDA right now. I mean, call it 10. Okay, so it trades at 10. Everything in the space and defense industry trades at multiples way higher than that, right? 20 plus. So this thing trades at 10. It's got a strong balance sheet. They're going to go list on the New York Stock Exchange this year. I think the Americans are going to take this thing higher, and that's a growth company as well. And then I have 3 picks, right, for going forward. This company, the NURS, N-U-R-S, we talked about this thing. I don't even know the proper name for it, but it's called like Albright Technologies. Anyway, the symbol's NURS, is an online pharmacy. So these guys, they started last June. They set up their pharmacy. It's very simple. You go on their website and you buy products that you can get in a pharmacy. How simple is that? But the problem is regulatory-wise, it's a nightmare in the U.S. You have to do all this at the state level. So these guys built a platform. It took them 2 or 3 years to do it, and so they're registered everywhere, and people are just using them to sell their products through this online pharmacy. And so they did 7,000 orders at the beginning of last year. And by the time they ended the year, mid last year was 7,000 orders. By the time they got to year end, they were processing 1.3 million orders. So this is a hyper growth story. It's the growth is off the charts. And so we think they're going to process, multiple millions of orders in 26. And if you do the math, it works out that these guys are going to make about 130 million revenue. Well, the market cap of the company is all of 220 Canadian. So we like that. We think it's going to, we think the stock's going quantumly higher. The stock's not that well known. The other one is Grow, right? In Brazil, it's the stupidest thing in the world, but Brazil's a massive agricultural economy. You know that they're second largest or the largest exporter of food products in the world, right? It's the U.S. and Brazil go back and forth as to who's number one. So, and they have no potash. So this enormous agricultural market, they have to buy their potash for some stupid reason from the Russians or from Canada. And you have to ship your potash 22,000 kilometers or miles. I'm not sure which, but you have to ship it from from the prairies here in Canada all the way down to Brazil, so that these guys can make fertilizer to feed the world. It's the most ridiculous thing. So there's this company called Brazil Potash, symbols GRO, and that company went public, $10 a share. Stock went all the way down to $1. It's now trading at $3, and they changed management. They got rid of all these shysters that were running it in the first place, that were completely incapable of building a mine. They put in some serious guys. We know some of them, and we like the story very, very much. We think that the NAV is about $50 a share. Stock's trading at $3. We think it should trade at probably 0.3. And the guys, the big American brokerage houses are all saying you need to be in potash, you need to own some fertilizer stocks. And if you look around, there's not that many to choose from. This thing trades already on the New York Stock Exchange. So they've done everything. Now they just have to finance it, right? Which is no small thing. But they have this huge resource in the Amazon, northern Brazil. They found it, they permitted it, and they've got the offtake agreements. It's all pretty much completed. What they need to do is get the financing, and it's big money. It's a couple $1 billion. But this project's going to make $1 billion a year for the next 50 years. So I think the bet is you just buy the stock and you just sit on it. It's an option on correcting this anomaly that the country desperately needs to fix. And I just think it's going to get fixed. I don't know how. I don't even really care how. You're just buying this great value. It's total value. The stock should be trading right now today at $7-8, just on the optionality. So what management's telling me is if it trades at 0.3 times its NAV, which is they think where it should be, it's a $13 stock. So that's a big pick for us. And then I was going to leave you, Dave, you were talking about the silver. Like, how do you play silver now? Nobody knows where silver prices are going. I suspect higher, right? I think the Chinese are going to reset the price of silver at north of $150. I think it's all happening, but nobody really believes it and stuff. And it's tough, right? I mean, it's gone parabolic, and we all know it should come back down, but I don't think it's going to, because the Chinese are setting the price. And there's a shortage, right? Global shortage. So we've come to the conclusion that the way to play it is, and the safest way to play it is you buy, there aren't that many silver companies, we all know. You should be buying producers. But we think that the best thing to do is to buy and you can buy silver cheaply, is you buy the guys that are going into production in the next 12 months. And so the fantastic thing is there are 5 companies that we've identified. I've got every broker in Toronto looking for another one. Just like Eric Sprott's doing, he's financing all these things. But we've only found 5, and so it's not a big list. All of them plan to go into production. Of course, there'll be delays and screw ups and stuff. Most of them are Mexico and Peru, but just buy those companies, because if you do the math, you're buying them at like 2 and 3 times EBITDA. Probably run rate end of 26. So really more like 27 EBITDA. When they get up and running, these things are priced at still 2-3 times those numbers, and that just won't stay. These things will go to 7 or 8 or 10 times EBITDA. So we think these stocks are all good to go up 3 or 4 fold. Which ones are there? And that's the one I put in the slide. That's called Silver Mountain, and those guys will be in production this year. And if you do the math, they're trading at 2 times EBITDA. It's ridiculous. So you're basically buying silver, right? They also have their reserves and whatever's in the ground. And I don't have the numbers off the top of my head, but all of these things are trading at, less than $20 an ounce in the ground. So you're not paying $120 for silver. You're sort of paying, 20 kind of thing, right? So anyway, that's what we're going to do. And there are 5 of them. The guys from Velocity will tell you all 5, but it's Exelon. They just raised money for another company called Silverco. They're doing that raise right now today. Highland Silver is one. Who am I? Silverco, right? It's being raised today. Exelon, and then this thing, Silver Mountain, and then Highlander. Yeah, Highlander Silver. So anyway, that's what we're doing. And it's interesting today, right? Silver and gold prices are up big time, but none of the stocks are moving. Today's the first day I've seen that, really. So I think that tells you that the markets just don't believe the move in the prices, right? Or at least they're hesitating now. Interesting times. Anyway, that's it for me.
Okay, great. We've got to wrap up here. Good luck out west, and don't forget to introduce us so that we can join you next year.
Yeah. I'll line that all up and we'll find some
Beauty.
investors.
Thanks, everyone. We better get on with our next meetings, and we'll talk to y'all later.
Thanks for listening to Lighthouse Outlook. If this conversation sparked a new perspective, share it with someone who thinks differently. Subscribe for fresh episodes every 2 weeks and visit mcnichollasset.com to learn more.